So I'm Kevin Shea. I'm head of solutions for Jupiter Intelligence. We're a physical climate risk provider based here in New York City. It's great to see all of you this morning, or I guess this afternoon now. So I'm going to talk about how our company, Jupiter Intelligence, is working with some of the largest financial services companies in the world, and some of the experiences and some of the things that we're doing to help them implement climate risk into business decision making. The place I want to start is understanding where financial services companies are today in that journey. In my time here at Jupiter, when I first started talking to companies, I used to call companies and they didn't even know who to direct me to. There was no one that knew anything about climate within the bank. Nowadays, there's head of climate, there's a lot more sophistication. And through our experiences with the different organizations, we've been able to put together a risk maturity index to really measure how we've seen progress for these different types of organizations. So you can see here I've got the scale of 1 to 5, where 1 being on the lower end of sophistication all the way to 5. And our observations are that there's really no financial services organization out there that I would truly characterize as a 5. Every company out there is kind of moving and striving to go in that direction, but no one's really there yet. The good thing is that there's also really no one who's a level 1. Everyone seems to at least be starting to ask the right questions. So most customers that we deal with are somewhere between the level 2, level 3 in terms of sophistication, and they're striving to get better. So how do we support them? What are the things that we do at Jupiter to help them along that journey? It's really 3 different areas that we start providing data to them so they can start understanding where their impacts within an organization will be. First is just understanding the basic hazard. Flood, wind, heat, drought, etc. It's the basis of everything that we do. Second is understanding what are the impacts of those things. So we've seen some presentations today, starts understanding what these impacts are, but they're not always obvious. Flood and wind, very obvious, very visible. You see it all the time in the news, extreme events occur, and those impacts make it obvious of what's happening in terms of climate. But when I talk to a financial services organization, I ask them, well, are you worried about heat productivity or heat impacting worker productivity? Are you worried about the impact on mortality risk? Are you thinking about if you have any investments in factories that are water dependent where droughts and lack of water could actually cause productivity impacts? And it's kind of that epiphany moment that happens where the answer is usually not really. And so we need to start thinking about those things. Because really the area that the banks and the financial services companies are aiming to look at is really the bottom. It's the thing that they're most familiar with. They want to understand change in asset value. They want to understand credit risk. They want to understand how this risk correlates with other risks that they're evaluating. And we certainly can do that as well. But we need to help them understand all 3 levels. As I said, that bottom area, that's exactly where a lot of the first initial questions happen. And there really isn't a great focus on where this data, where this information is coming from. Obviously, if garbage in, garbage out, like we can evaluate financial metrics, but we need to make sure that the climate data itself is good as well. So here on the slide, I've characterized what the process of working with an institution looks like. We take these different climate perils and we model them at a really high resolution, 90 meters, so that we can evaluate asset level data. So in the example that I'm going to walk through where we're looking at a mortgage portfolio, we're coming up with hazard, damage, and financial modeling or financial impact metrics for every single property for a bank. And that's a lot of properties. We work with some of the top 5 banks in the world. We're processing millions of data points per day so that they can utilize this information for downstream decision making. So what are those business impacts? It's really what you see on the right. We're looking at portfolio risk. We're looking at the individual assets. We're trying to determine if there's going to be a change in maybe some of the cost of insurance, the cost to maintain these properties, looking at credit risk, and then also looking at how we can mitigate or adapt against these climate impacts. So we're going to focus just on a quick use case on these 2 areas here. So the concept I'm going to incorporate or talk about is what we refer to as our climate-adjusted valuation. So climate-adjusted valuation, when we're working with a bank, we're trying to help them understand, is the current value of an asset different today based on what we know could happen in the future? So there's a tremendous correlation that we've seen, right? When an extreme event happens, a flood or a hurricane, something happens to a property, the value of that property decreases. So if we know, if you look at the value of an asset, and we know that that asset is going to be impacted by more floods or more hurricanes or more climate impacts, we can make an assumption that the value of that asset is actually lower than what you probably think it is. And we'll walk through an example to show what I mean that. So when I talk about climate evaluation, I'm talking about taking our current value of an asset and adjusting it for what we know could happen in the future. We're not fortune tellers, we're just, based on probability and real math, right? So how do we do that? So there's really two different approaches. One, we want to look at, if we're looking, let's say, at a home, a single family home. I own a home. If I'm looking at my home, if it's more expensive for me to own that home, the value of that property is probably lower, right? So if I'm paying more for insurance, I'm doing more for maintenance, I have to be out of my house because of more floods, more large events, that means that the value of my home is very likely lower. With commercial and industrial, it's a little bit different, right? Because really the cost of ownership is a piece of the puzzle, but not the whole thing. If I'm invested in a commercial asset, and I know that in the next 5 to 10 years, the ability for that asset to generate revenue is lower, then it is reasonable to assume that that asset has a lower value than you probably think, because we know in the future it'll be less capable of generating revenue for you. So let's look at a specific example. So we're going to look at just a very basic home. Hopefully this is a real easy example. But if you think about all of the components that goes into the valuation of a property, it's, I'm paying my mortgage, I'm paying my insurance, there's repair costs. For homeowners, all the time, there's always something broken. I've got, utility costs. And then if I'm displaced from my home, I've got to pay to go somewhere. All those elements, except for mortgage, we can't do anything about the mortgage payment likely, have an impact on the total cost of ownership of a home. So what does that look like? So we assume at Jupiter that the value of any asset today is likely, or at least the value of the climate impact for an asset today is likely constant as you move forward in time. No one is working with their real estate broker to adjust their home to climate impacts that are happening 5 or 10 years. So if we isolate just the climate component, right? Value of a property, there's a lot of factors, but we just isolate just the climate. We can assume that today, if you look in that second column on the table, that the impact on climate is probably viewed by most to be constant over time, because no one really is utilizing these climate metrics to understand what future impacts could be. But at Jupiter, with our climate data that we have, we can project what that could look like. Based on our data, we can say, well, actually, the amount of impact due to climate is going to increase over time for this property. So if you look at the blue and the red line on the right, the blue line indicates kind of the view of how the valuation in terms of climate impact is today, where you assume over time it's roughly flat, right? No matter where you live, you assume, I'm either going to have high, medium, low risk to these different climate impacts. But utilizing forward-looking climate data, we can actually get a more true picture of what the odds would say are going to happen at that particular asset. So what we're trying to capture is the gap or the space between those two lines. Taking the assumption of what the value of the climate impacts are today versus what the climate data shows us, that delta, that change, that's the change in the total cost of ownership. That's the change in how much I'm paying as a homeowner to account for the fact of these future climate perils. So how do banks use this information, right? Well, they're looking at it from a slightly different lens. So I've got some examples, some properties. They have a current value of your property. They know how much is on these different mortgages, and they can calculate a loan-to-value ratio, right? And the higher the loan-to-value ratio, the higher the probability that a homeowner could default, and the lower is true, is the opposite is true. So what we can do at Jupiter is we can take that current value, and we can adjust it using this methodology and say, what does a climate-adjusted value tell you about the current value of that asset today? And with that, because we know how much is remaining on their mortgages, we can also calculate a climate-adjusted loan-to-value ratio. And this is the type of information then that feeds into bank models to be able to calculate the probability of default, loss given default, and a number of other credit risk metrics. Another example is we've worked with banks to aggregate this information so that they could create maybe not in production underwriting rules quite yet. There's a lot of compliance things that have to happen at banks before we can get those things approved. But to give them a sense of how the risk will change. Now, I've anonymized these numbers here, so don't read too much into the specific numbers. But what we've done for the bank as an example deliverable is say, actually, let's come up with some factors to say, estimate generally for particular regions that you're in, what the decrease or change in value is over time. Now, I caught myself because most of the time we're seeing more climate impacts, but the opposite is also true. We also see areas where the climate impacts are actually decreasing, which technically with our methodology would mean that price of your assets would actually increase over time. I don't necessarily ever advise a bank to think of that way. I usually tell them you could probably assume it's constant, but based on our methodology, we do also see areas where climate risk is decreasing, and those areas are relatively stable. It's all about this risk versus opportunities, right? There are plenty of risks out there for climate. There's also a number of opportunities if you can identify the right areas where climate impacts are minimized. Jupiter has a number of partners. One of the most public ones that we have is with Bain. Bain did an analysis on a really large mortgage portfolio in Italy where we looked at a number of different perils. And this is just an example of the type of output that we've done. So what they looked at is they said, let's change the point of mortgage origination for the next, let's say today, 10 years from now, and 20 years from now. So we say, if you write a mortgage today, how much as a bank can you expect to lose in terms of net income or profitability on that mortgage portfolio? And they came up with a number of just under 7%. But that number increases as you go out in time because the climate impacts increase as we go out in time, right? So if you originate a mortgage in 2030, if you look over the length of that mortgage, you're expected due to climate change to make about 8 to 9% less than you would today based on these future climate impacts. And so this is the type of insights that we're providing where we can identify regions and zones where based on climate data, they're telling us that these areas will become less favorable to underwrite these type of financial products. So in conclusion, let me wrap up by just saying this data that's being used, it is real. It is being used in financial institutions today. There is a very exhaustive process to get this information approved for use. So one of the things that we do here at Jupiter is that we spend a tremendous amount of time focusing on transparency, education, and understanding of where model limitations exist. Because there's a lot out there about future climate data, and it's not all ready to be used in financial institutions. So there's a lot of considerations that have to go into it, and so we probably spend 12 to 18 months working with a bank to help them understand what the data is and how it should be used before it actually gets into a production system. So a lot of use cases that are out there today. We're going to see more and more over time as customers go along that climate maturity index, but hopefully this was a really great example of how we're doing it today. Thank you for your time.